what I'd like you to start with, sort of to set the tone for the conversation, is, obviously we've been doing a deep dive for the last couple of days, and we've been talking about the applications of machine learning and AI. How far do you think we've come, and how far do we need to go in terms of integrating AI and that capability throughout an organization? Obviously, there have been niche groups within many big organizations, probably Bloomberg and others included, but that knowledge base, that capability has to permeate really to take full advantage. What thoughts can you share about that?
So I think it depends on the organization and how large and complex it is. And two, it also depends on the people that are involved in trying to integrate AI. And I'd say that the early successes that can be had and that are visible oftentimes will determine the embrace that you see across an organization. I think what we're starting to see, or at least what I'm starting to see, is a little bit of a hybrid approach where you're taking, say, for example, within a research operation, your traditional fundamental analyst trying to understand how machine learning, big data can help make their own analysis a bit better. I think that there's a bit of selling that needs to happen, because oftentimes people that have been ingrained in their own analysis, it takes a while for them to start to embrace new techniques. But the more results that are visible, the more people can understand on how it could enhance their investment philosophy. That's when you start to see the integration coming together.
And it's happening. Would you say that we are at the beginning, or are we partway through? What would be your guess?
I think if you look at the amount of information that is coming, that's covered in the press, that you see in terms of the questions that we're fielding on how we're using big data or artificial intelligence, I think we're definitely moving further along. And my own impression is over the last 2 to 3 years, there's a much greater understanding. Now, we're not, your traditional long-short funds, your traditional fundamentally driven investors are at different phases in the cycle, but the interest level is there, and there's so much, I think, opportunity that people want to learn more, and it's just a matter of whether they're at the beginning of just kind of exploring how they can embed AI into their investment processes, or whether they're actually doing the work and making the investment to do it properly. But we're getting there.
And Arun, I'd like to jump to you. Bloomberg's a tiny organization. You are part of a quantitative research group within Bloomberg. There are multiple facets of that company. You've got the media side, you've got the terminal side, you've got research, you've got Tradebook, you've got all of these pieces that there doesn't seem to be, unless you're inside of Bloomberg, a logic of tying them together. But where do you fit in that puzzle?
Yeah, so we are in the financial product division, which serves our terminal business as well as our enterprise data license business. So we help with quantitative research across those areas, and and we are an umbrella research team. We are helping many different incubation of many different business projects and ideas for the company. And to tie it back to the previous question, I mean, it's one of the things we noticed is that to build capabilities for machine learning and data science, we took like a sort of a two-phase approach. We wanted to first build something for internal use that we can empower our own data scientists and quants to build, to do sort of quick sort of building their projects, and then moving on to building sort of actual toolkits and products which are still internal facing that help our businesses for their deliverables. But now we are slowly turning that around and putting out a platform product which is based on the same infrastructure, which is going to be client-facing, where our clients will be able to come onto a Bloomberg ecosystem and actually carry out machine learning tasks. They will be able to program against our data, use Bloomberg's libraries and APIs into different analytics, and be able to have a sort of a full computational environment.
So you kind of were the internal beta testers, sort of getting it off the ground, and then someone came along that was smart and said, let's package and sell it.
It's an interesting role because we do help with the initial incubation, and then we flip back around and act as customers as well. So it's pretty exciting.
Excellent, excellent. And Andrej and David, I'd like to go to Andrej first, and then David with the same question. Both of you are investment managers. This isn't sort of basic to explain to an actual investor that you might be talking to. Some of these methodologies, whether it's a quantitative investment strategy or something that is, including AI or some very complex mathematical algorithms, how are you selling this idea to your end investors? And Andrej, I would start with you. Are you finding, sort of based on the type of investor, a different level of sophistication and understanding of what it is that you do?
Absolutely. The level of sophistication varies dramatically. Some people are actually on the cutting edge and they do understand what it takes. They can spot and sift through the managers who know what they're doing versus those who are just at the very beginning of this process. And there are others who are just getting to learn what it takes, and they're at the very, very early stages. Now, the way you sell it, there is no right answer because most of these techniques have not really been tested by a large group of people. So it's a little bit early to say that it is being adopted by a lot of people. So what you have to do, you have to find people who are believers in this space, number one, and are ready to take a leap of faith to invest in you early on. The reason they have to do this is because largely, and almost by definition, these quantitative strategies are capacity constrained. So by the time you have a long enough track record to market it, you don't really accept a lot of new capital in. So it's a chicken and an egg game. Relating to an earlier comment, what needs to happen, I think there is one fundamental problem with fundamental investors, stock pickers, shifting into machine learning and big data applications and using that internally. The reason is, let's say you're a discretionary stock picker, and all of a sudden you have a group of quantitative guys and PhDs helping you with your investment decision process. Who takes the credit internally? That's a big question, and it drives a lot of decision making. But our belief that people have to work together in order to solve this. This is not trivial. It's not trivial by any extent. And motivations matter. So unless you design a process where people work together to come to an outcome, it's hard to solve. And there's another problem. Discretionary analysts are usually operating in silos, and there are good reasons for why that is the setup, where quantitative managers is good to work as a team. You need technology, working together with data, working together with machine learning people, working with people who understand how markets work, all working side by side. And that's not easy to achieve. So some smart investors have already realized that, and they're looking for different types of talent within an organization. And once they spot it, they're ready to allocate. Other people are at the very beginning, you need to educate them.
You need to educate them. And David, in terms of your ability to explain this, or the types of investors that are in your hedge fund,
Sure.
Is there a level of sophistication that you aim for? And then I would like you to add to that, what category do your investors tend to be? Are they family offices, wealthy individuals, or are we talking pensions, endowments, foundations, and
Sure.
institutions?
So, we're fairly new. So we launched in August 2015. And in the beginning, it's been friends and family. We're starting to, we're getting feelers out there, and the conversations, are now becoming a little bit more serious. We're getting looked at more carefully now. In the beginning, it was all about black box, quant. There were a lot of things you have to overcome in the beginning, but almost at 3 years now, and with our performance and going back to the most recent political cycle and being able to, point to, hey, our algorithms predicted President Trump victory in June of 2016, and this is what we did since then. We've
Another
done very
Trump indicator.
we've done very well. But a good fund manager, from my perspective, you've got to anticipate these factors, and that's kind of we predicted a Trump victory. We're not mimicking. We're not loading up on any one factor. We're spreading out the risk, and we're anticipating these factors. So I believe investors are starting to see the robustness of our models, and we're getting some traction from family offices now, and sophisticated ultra high net worth individuals. So.
Okay, and Andre, back to you for a moment. What types of investors does your fund attract?
So we have taken a slightly different approach. We're building a firm for a very long term. So the first couple of years we took just to build technology internally. We're lucky enough to get seated by a multi-billion-dollar family office, so we didn't really have to worry too much about expenses. We have invested a lot, both time, money, and intellectual capital in building the platform, and we've been trading on a managed account. And we're just about to open up a fund. The traction we're getting is, I would say, somewhat similar. More sophisticated fund of funds, seed allocators who believe in this space for the long run are interested, and ultra high net worth individuals who, in my experience, just like the hype of the story, and they understand conceptually that this is the future, but they're not in the weeds yet, understanding of what it takes and how it works.
Do you add to that?
I just want to add, sophisticated investors, they appreciate, we're protecting your cap. We're not an all-weather fund. We like to perform, obviously, in every environment, but we're protecting your capital from systemic risk or systematic risk. And sophisticated investors, no matter what, they get it and they appreciate it. People that, these retail investors or these high net worth in-between investors that, listen to CNBC and Bloomberg all day, that's just not our guy.
They're higher maintenance investors, right? And I can understand that. And I'll tell you, it is something I've heard from numerous managers that, they would rather pursue family offices that might have a more sophisticated internal team, or they'd rather pursue a pension or an endowment or an institution, for that matter. An individual ultra high net worth person, you could be a multimillionaire and not understand what a Sharpe ratio is, and most don't.
Right.
So I think that there is that challenge of just high maintenance and education and sort of bringing them up.
The
to
education
speed.
part's great, because at the end of the conversation, they get it, but there's still risk, and some of these high net worth individuals, they don't get it. They just see the S&P going up one way. They forgot what it's like, volatility and whatnot. So,
Great. So, one of the things that I like to do, and, I've had a long resume, so you guys don't know this either, but I used to pick managers and seed them. So I had a fancy title once called the VP of Capital Introduction. And for 2 funds of hedge funds, my job was to does anyone remember a performance system called PerTrack? Does anyone remember that? So my job was, I was the PerTrack guy. I was the guy who understood how to use the PerTrack software. I was the guy who ran the system and worked with an investment committee of allocators, including people like Jack Schwager and Tom DeMark and others, to sort of pick managers and put them into fund of funds. And along the way, one of the things that I like to do is I like to find out from managers. And I'm going to start with the managers, and then I'm going to ask Pam and Arun to sort of chime in as well. But why don't you tell us for 2 minutes, starting with you, David, your story. Give us your elevator pitch. What is Coral Gables Asset Management? What do you do?
I'd like to think at the end of the day, no matter what, we protect your capital at all costs.
What's your strategy?
So we are a market neutral, long, short quant fund. Again, it's based on the emerging field of behavioral finance. I guess I wouldn't consider it emerging anymore. I think it's, we're seeing a little bit more behavioral finance in the theory and the application today. We have three main signals or models. The first model is geographic diffusion. The second model is a sensitivity to the political environment, and the third model is your plain Jane momentum model. The first two, it's very intuitive if you think about it. Geographic diffusion, it's really how one company, we say there are X amount of publicly traded companies in the United States, and on average, 6 of them are economically connected geographically throughout the U.S. So, if we can predict what's going on in California or what's going on in Texas, via certain variables or factors in the macroeconomy in these individual states, then we should be able to predict a quarter ahead or 2 quarters ahead earnings, and we come up with our long-short portfolio based on the sensitivity and the frequency. The political sensitivity environment, or sensitivity to the political environment, it's basically we're mathematically assigning betas to each industry, and we're analyzing through textual analysis and other programs how sensitive an industry is to a Republican regime versus a Democrat regime. And we will put our stocks into 2 baskets and build our second model that way. And then the play momentum model is just your play momentum model. Nothing unique there. We are systematic. We have a ranking system for stock selection, and that's it.
That's great. And Pam, I haven't forgotten about you. So if you could give the microphone to Pam, if she doesn't know, she has one. Okay, great. So you have a couple of hats. So you you have a team that provides in-depth analysis and ideas across equity derivatives, but you also co-lead a data innovation research at Deutsche. What is that?
So effectively, I think, going back to how do you pitch using alternative data and analysis techniques to clients, or even internally, the proliferation of data has been incredible. There are a number of presentations on it today about how many alternative data vendors are out there, how do you use data within an investment process. What we're trying to do at Deutsche is, across a very talented team of analysts that cover different stocks, sectors, macro analysts, understand what data inputs we have internally already, how they can be leveraged to come up with intelligent investment signals that are differentiated, how we can help our clients with their own data needs, and also within our quant research effort, we have a very talented team of researchers that are rooted in their entirely independent analysis that will look at some of the newer quantitative research techniques, that factor construction, testing out new data sets, publishing on those techniques, and then helping clients embed those processes and their findings within their own investment philosophy. So what we try to do is be a step ahead of what our clients are looking at. Won't have the answers for everyone, but certainly trying to, from a very rigorous research standpoint, understand what some of the new techniques in the market are, and partnering with clients to help make their own investment decisions a little bit better. And I think, going back to the earlier question, oftentimes that's bridging the very sophisticated, purely quantitative approach and a stock picking approach that has traditionally been more fundamental in nature, and trying to get people to understand, well, here's an overlay strategy that can help you make better investment decisions.
Right. So they might not be ready to go purely quant, and they have a comfort zone, but you can help explain how sort of the quantitative aspect can be an overlay and sort of reinforce those signals.
That's right. And I think that, just about anyone is going to understand right now that new data and what is and how quickly signals are changing, it is going to be a benefit to try to embed that into your investment process, no matter how active of a manager you are.
Great, thank you. And Arun, over to you. What do you do?
Well, Yes, we do wear a bunch of hats. Well, first of all, just to sort of back it up, as in Bloomberg is more of a services company, so we essentially provide news, data, and analytics.
Sure, but how about you? What do
yes,
you do?
so we help with looking at some of the new data sets that Bloomberg is onboarding, like supply chain, for example, and extracting derived signals from it that we can help, that can help market the data to our hedge fund clients, for example. A lot of the times, the raw data itself is quite a beast, right? So we help clean it, normalize it. We make sure some of the aspects that are important for quants to work with. For example, the point-in-time quality of these data sets is critical. As you know, some of the machine learning models that people are trying these days, they're essentially error maximizers in a way, because if their data has any errors, then they will essentially learn that error and be very, very biased. So it's very important to make sure data is free of those biases, whether it's any sort of look-ahead bias or any survivorship bias. Those can really be critical, especially in a black box environment like machine learning. So we try to bring sort of scientific rigor to these different businesses within the Bloomberg, make sure they are following the best quant practices.
Great. Andrej, give us a little more of a deeper dive of the strategy. Obviously, you're very lucky you had a family office seed you, but that's not going to last forever. You're soon going to have to go on a road show and explain it to someone like me that is skeptical, that is going to ask you and, look under the hood and ask you about every aspect from your team's pedigree down to, will you please show me what's in Form PF? So please give me an elevator pitch, if you would.
So we started thinking about this company back in 2010. The idea came from us from fundamental investing. We saw that changes in information and access to information drives security prices. The more you have of it, the better information you have, the better decision making you potentially can make. There was a second trend, which was very obvious even back then, that the enormous growth in information is likely to continue, and a lot of that information is coming in machine readable form. What that means is there's just way too much stuff that is coming towards humans. You need a platform to be able to utilize all of those data, bring it together, structure, and make informed investment decisions. We went out and pitched that idea to a number of people. Eventually pitched it to Jamie Dimon of JP Morgan. He loved it so much he wanted it for himself. So he hired one of my friends and now business partner to build the first big data machine learning unit within JP Morgan. After doing that for a few years, we spun out, or he left, and we restarted Data Capital Management back in late 2014. Now what we do, we bring in quite a bit of different data sets, both traditional and non-traditional alternative, and we build investment models on that. Differentiation that we have, we think, is our regime-aware approach. We do not believe that systematic investing works in all the regimes. It works until the regime changes. And that goes back to machine learning. If you train your machine learning on a certain regime, then the regime changes, it doesn't realize it, it's not going to produce great results. A very intuitive example of that would be you have a trend following model in a side-based volatility market, it's unlikely to work well, and vice versa. Therefore, regime prediction is paramount, and selecting of which models to allocate capital to in the forthcoming market regime is very important. And in a nutshell, that's what we do. We have different investment families of investment models, about 7 or 8 right now, and each family has a few models underpinning them, and we have market economists, as we call them, a set of strategies that define short-term market regimes, giving alternative and traditional signals.
Great. Are there any questions so far from the audience? All the way in the back there. If you could stand up. We'll get you a microphone, but if you want to yell, I'm sure we can hear you.
I'll wait.
Okay.
Hello, guys. This question is for Pamela. I was just wondering, from a mature organization, how do you manage success and failure prior to execution of derivative strategy, and what method does a big firm like you guys use?
So interesting question as we're trying to embed more data science across the organization on the investment banking side. I think part of it is to communicate the benefits to to internal stakeholders in terms of what the new process or why, trying to centralize and put more governance around data that we have internally, where we're going with the end goal of doing this is, because for the people that are involved, being asked to contribute, for them to think that it's not just a tax on their time, but that this is something that you're going to get a benefit from is critically important. The other thing I'd say is, as we've been trying to move into more data science techniques across our research organization, it's also showing some wins early on, having a tangible product that we can show, that we can talk to our clients about, that we can be showcasing as an example of where we're going. Technology is always a challenge in a large organization. So trying to find out what can be done with the individuals that are working on the project, as opposed to waiting for everything to be perfect on the infrastructure side, is another way that we can that we've been trying to show progress. Does that answer your question? Very good.
Thank you. So I have a question for all of you, and I'd like you to maybe tackle this one by one, starting with Arun. What are the dangers of machine learning? Are there pitfalls? Are there risks? Are there things that the people in the audience and their clients and their end investors will need to avoid? Can you guys chime in on that?
Absolutely. There's a lot of dangers and risks. I think one to point out would be lack of interpretability, which is a very big problem. Especially with more like deep learning methods, which are more like black boxes. It's not even, even though you do use all scientific rigor to make sure these methods work, they are using all sort of, proper cross-validation techniques and the, performance in auto sample is done correctly. It's still not clear as to what exactly, how are the input factors being blended to come up with the final answer. And for some people, it's very important to know exactly what the transparency on how the factors are being blended. So, and with these methods like deep learning, it's almost impossible to do it very, very clearly.
Right, and they might not understand what it is that is in the box. So it's quite difficult.
Exactly,
sometimes.
like one technique that we employ to help with the interpretability is to take a complex model and take a bunch of simple models and maybe help explain the complex model in terms of the simple models. So maybe try to find a way to quantify which model, which of the simpler models is the complex model closest to in outputs, and that's one way to kind of gain some interpretability, but it remains an inherent hard problem.
Great, thank you. And Andrej, you touched on this a little bit in one of your answers earlier, but what are those dangers? What are the dangers of sort of machine learning and its application to investments?
I'll be speaking about this a little bit later, but in a nutshell, in my view, first, it's not a magic box. It's actually pretty hard to make it work consistently, and it takes quite a bit of different resources than most organizations have at their disposal right now, both on the data side and technology side, and understanding how to apply both. Second, underfeeding, overfeeding, usual problem that everybody faces. How do you make sure that the trade-off between bias and variance is acceptable to you and what actually it means? And thirdly, regime determination and feature engineering is actually hard. A lot of machine learning techniques were developed for advertising technology, and it's not a plug and play where you just take it from the West Coast, bring it here, and all of a sudden it works. There are thousands of features to choose from.
Right.
In ed tech, there are a little less, quite less. And I would argue strongly that domain knowledge and understanding how markets work matters in building a machine model that works outside of your testing.
So you shouldn't
period.
necessarily just come from a computer science or that type of background. You should have some basic skill set with regards to the markets, right? With regards to
I'm
sort of
speaking from a
financials.
personal experience trying to, being part of building this from scratch. I do not believe that it's enough. The reason I don't believe that it's enough, there are just way too many degrees of freedom. And there is not enough computational power in the world to just throw everything at it and get the machine learning to come up with an answer.
And maybe if you've traded it without it before, you know pain. You know, maybe you know and have experienced the traditional way of doing things, and you might bring this innovative piece to it, and it might make improvements, but you have that knowledge, that history, you know, those skid marks. So you've been able to...
The way we view it internally, at least, is the following. If you fundamentally believe that there are factors that predict the future, you should be able to enhance that predictability with machine learning, given that you have good data and some good techniques and machine learning expertise.
Right.
Now, if you do not have the understanding of what could be predictive, it's like looking for a needle in a haystack. It's really hard. And if it were not hard, then Google would have been the biggest hedge fund in the world. But
So it's kind
they
of like...
tried,
Yeah.
and they did not achieve it yet, not to say fail.
Well, it's kind of like you can figure out the answer if you know the question. If you know what questions
In a
you should
sense,
be
yes,
asking.
but it enhances your abilities. So you know 5 factors that, I'm just coming up with random numbers, you know 5
Sure.
factors that are very predictive. Machine learning can come up with 10 more. And 5 of them may actually make sense to you if you really think hard about them as a human. But without the machine learning algorithm, you may not be able to discover them.
Anticipate.
So it's man plus machine that need to work together to really make it happen, in my view.
Thank you. And David?
Yeah, and just to tag on his point, you know, it's really understanding the underlying mechanisms of what makes, you know, all this work. But just, you know, from my personal experience doing this, being one of the co-architects, you know, it's data snooping. You still have biases no matter what. You know, and at times you've got, you know, too many parameters, you know, too many observations that can throw a wrench in things. And the big thing for us, it's regime change. You know, being able to accurately predict regime change. So that's...
Thank you.
And I would just add, you know, as an analyst, I find it incredibly important to be able to understand, to be able to explain why something's working, when it will work, and when it won't work. So you know, going back to the points made earlier, it really is important to have it not be a complete black box where there is some intuition about where the performance is. And, you know, anytime that you're looking at a back-tested strategy, you have to be able to explain why there was a drawdown, why there was underperformance at any given time. The machine learning aspect can actually help to help, you know, whether you're training a model to understand how to mitigate those circumstances, but there needs to be some tie to what's actually happening in the market. You know, is it an unexpected Trump victory? Is it that the Fed is going to be more hawkish next year? How is your strategy going to react in those situations? And being able to explain what inputs and outputs are going to come out of your model to some degree is what really resonates with investors in my experience.
Thank you. Thank you. Are there additional questions from the audience? Yes, sir. Someone's going to bring you a microphone.
This is a little out of left field, admittedly, and maybe a better question for the computer scientists in the room. But I'm just curious if any of you four have any thoughts on the potential impact or non-impact of quantum computing in finance over the next 5, 10, 20 years.
Just, I'm going to be short here. I think it's going to create opportunity. I think it's going to create inefficiencies, in my point of view. So,
Yeah, I think purely from being able to do access, you know, more heavy computational power, it will enable machine learning capabilities to just achieve more efficiency. So, you know, you'll be able to, you know, probably throw more factors at a problem. You'll be able to work in a big data setting even more efficiently. So, but in terms of, you know, any inherent benefit of the quantum computing itself is not. It's just purely in the computational power sense, not anything else.
Right.
I'll to try to add 2 cents to that. I don't think we're limited by computing power right now, given access to AWS and those services. We're limited by other factors: data availability, cleansing, factor selection, regime changes, and making smart choices around there. It's not about, oh, I can't compute what I need to compute,
And
to a
then-
large extent.
Go ahead, Dave.
No, I just, back to my point, people do think, like, you know, based on this question, and that's why I feel that, you know, we're gonna have there's gonna be great inefficiencies in the market from that, you know, logic, I guess.
So, are there additional questions from the audience? Yes, Miss?
So David and Andrew, you both mentioned regime changing is very important factor in your strategy, but it seems David is mentioning machine is predicting the regime switching versus
His pre-Trump
Andrew.
indicator.
And Andrew is putting that to the market economists. So did you actually do testing like Norman earlier suggested today to pitch machine prediction against humans and based on the accuracy from the past, decide whether you should give the decision to machine or human, or you just go with the comfort level? And also, if you make human make the decisions, are they really detecting the early signs of regime switching and therefore tell you that it's switched, or is actually telling you it's about to switch and making a prediction?
So our computers run everything. You know, there are a few occasions where I'll look under the hood. You know, I'll give you two examples. We were probably one of the only U.S. Steel. I'm going to throw it out there. Back in March or April when they reported earnings, we were short, and there was a lot of momentum in the steel industry with the Trump, you know, victory and whatnot. You know, I was a little nervous. You know, but thankfully it went in our favor. And another company, I'll give you another example, ALGN, Invisalign. No idea what this company's about. We're long going into earnings. I Google ALGN and I see orthodontist and I start freaking out. Why is an orthodontist worth, you know, this much money or market cap? So there are some instances where I do look under the hood and I have to make a judgment call. You know, but 99.99% of the time, the computer does everything. When I speak about regime change, I'm not going to just, you know, we're always evolving and we're always, you know, testing the coefficients, you know, on a weekly and sometimes daily basis. So even though the computer is doing everything and the algorithms are always spinning, you know, now, for instance, we're, you know, it looks like we're heading into, or we're already in the midst of a regime change. So. Your clients, you know, they expect you, I wouldn't say be fortune tellers, but, and I don't, you know, we're not fortune tellers, but I'd like to anticipate, you know, some of this change, so.
Great. And I'm going to start with Arun, and then I'd like to go down to each of you. Is there something I didn't ask you that I should have that you would like to comment on? Is there any point you would like to make, you'd like to ensure that the audience hears?
So you know, the phase of innovation and early adopters, I think, is already over. So, and I think we are pretty much, I think, in the mainstream. I think I don't think it's still in early adoption phase. So, it's here to stay. I think it's here to benefit all of us. You know, machine learning and AI. So we just have to, you know, be careful in the way we employ it, and you know, we have to just make sure we study it properly, both from building it as well as how we test it, how we cross-validate, all of those best practices. So this is what I'll leave that with the audience.
So the ship already sailed, and now it's up to the industry to sort of standardize and deploy.
Right. I think other industries have sort of taken the lead, you know, with the efforts at, you know, Google in particular, Amazon and Facebook, and you know, we basically, in some fashion, we are taking the best of techniques and ideas from, you know, especially in deep learning space from there, and there's a lot of work that's needed to adapt it to the financial world, and that's where I think we come in. But you know, it's clearly you know, a real thing, is here to benefit us. So.
Great. Andrej, what would you add?
Well, I still think we're at the beginning of this phenomena, which we call data economy and artificial intelligence in finance. 2 years ago, when we just started speaking about it, most of the people looked at us like we were crazy. Now everybody speaks about it. I do think that actually it's a little bit overhyped, there isn't fundamentally anything extremely different. It's just more information to make better decisions on and better tools to make those decisions. Right now, there's things are called alternative data, like sentiment index, news ingestion. I
But
can
those are
guarantee you
things that have been around a while, right? So I remember
a lot of people have been
15
doing
years
that for a
ago,
while.
there was sentiment analysis on news that was done with alerts. But would you maybe call this a repackaging of it, a rebranding of it in a way in which it's kind of its own brand that's being pushed forward?
There is
Because-
definitely a repackaging that
Yes.
happened. But my point is, what seems alternative today will not be alternative tomorrow. Something
Good.
else will be alternative. And the name of the game is to stay ahead of this and anticipate what is likely to come. We try to anticipate it with building robust technology that will last for years. And there are other ways maybe to do it. And if you have insights, I'd love to hear them.
Thank you very much. And David, what should I have asked you that I didn't? Well, many things, I'm sure.
Yes. No, but just so I think it's I think we're in the beginning as well, and I don't think we really know what all this means yet. I do know, scientifically speaking, having data to support our theories or our rationale behind selection, it's good. It feels good, and you can pinpoint why things are working and why things are not working, and you can articulate that to the client if you understand the underlying mechanisms of your strategy and how it works. But we have a long ways to go. So.
But it's a good thing. And Pam, what would you add?
Just the most important point, I think, and what I always encourage my team to do is remember that we're trying to make money out of this. There's so many different new techniques. There's so much data out there. There's so many
Okay.
interesting things that you could do with it. But if you're an investment professional, you need to know how to actually use it to benefit what you're ultimately trying to do, and that's make a profit and have it enhance your investment strategy. Otherwise, it just becomes a science project.
So incredibly important. On that note, please join me in thanking our panel.